Hey guys, welcome back to the Bitcoin Fortress podcast. This is episode 212, recorded here on Sunday, April 19th, 2026. Block height is 945813 Moscow time, 1329, and fees are 1, 1, and 1. This week was a very Bitcoin kind of week. We got geopolitical panic, a fast sell-off, a sharp recovery, more institutional adoption, more corporate treasury buying, more debate around the future of the protocol, and more evidence that Bitcoin keeps expanding even when the world feels unstable. That, to me, is the big theme this week. Bitcoin keeps absorbing shocks and then moving forward anyway. So, with that, let's jump right into the news. Early in the week, Bitcoin dropped below 71,000 after markets reacted to President Trump ordering a blockade of the Strait of Hormuz. Whenever you get a geopolitical shock like that, markets tend to sell first and think later, and Bitcoin is still liquid enough and important enough that it gets caught in that initial rush for the exits. Also trades 24/7, 365, unlike the stock market. I think that this is a useful reminder for Bitcoiners. In the short term, Bitcoin is still treated like a global liquidity asset. When traders get nervous, they sell what they can sell. That does not invalidate the long-term thesis at all. It just means Bitcoin still lives in the real world, and the real world is volatile, emotional, and levered. What matters more is what happened next. By the next day, Bitcoin had already moved off the lows and recovered back to the low $72,000 range as the worst of the fear started to pass. That rebound is important. It tells you there was real demand waiting underneath the market. In earlier cycles, Bitcoin could get hit by a macro shock and stay weak for a while. Now it feels different. There's more underlying demand, more structural buying, and more participants waiting to buy weakness. That doesn't mean straight line up. It does mean Bitcoin's market is maturing. By midweek, Bitcoin was back above 75,000 for the first time in about a month. That's a big psychological level, but more importantly, it shows how quickly the narrative can shift. One minute, Bitcoin is being dumped on war headlines, and the next, it's right back to acting like a high conviction monetary asset with persistent demand underneath it. For me, that's the real story. Bitcoin is increasingly behaving like something the market wants exposure to on weakness, not something the market is just speculating on blindly. Another interesting piece this week was the reminder that Bitcoin has now moved beyond the halfway point of the current halving cycle. What stood out is that this cycle still looks different from previous ones. Price appreciation has been more muted relative to prior post-halving periods, at least so far. I actually think that makes a lot of sense. Bitcoin is a much bigger asset now. It has ETFs, treasury companies, more institutional ownership, more derivatives, and far more macro sensitivity than it used to. It would be surprising if it still moved exactly like it did when it was mostly a retail-driven asset. So I think the lesson here is don't get too trapped in old cycle templates. Bitcoin is the same protocol, but it is not the same market. Moving right along to treasury adoption and institutional demand, Strategy bought another 13,927 Bitcoin. That brings their total holdings to nearly 781,000 Bitcoin. At this point, Strategy is no longer just a company that owns a lot of Bitcoin. It has become one of the main engines through which traditional capital markets are converted into Bitcoin demand. Love it or hate it, that is now one of the defining features of this cycle. Michael Saylor and Strategy have shown that there is a market for public company that essentially exists as a Bitcoin accumulation machine. And because public markets continue to fund that machine, it keeps going. The big takeaway is that the treasury model is not theoretical anymore. It's real. it works, and other companies are watching. This week, we also saw reports that Strategy's Stretch ATM structure did enormous volume in a very short window. That matters because it shows this strategy is still being financed at scale. Public markets are still willing to feed the machine. That gives Bitcoin an ongoing bid coming from the legacy financial system through a corporate wrapper. Now, as always, I'd separate Bitcoin, the asset, from the financial engineering built around it. Bitcoin remains beautifully simple. These wrappers are not simple. They come with leverage, structure, and risk. I mean, I think Stretch is paying 11% interest, and I think they're even doing it now every 2 weeks instead of monthly. So, where does the yield come from is always in the back of my mind. But the bottom line is still bullish for Bitcoin itself. More capital market plumbing is now connected directly to Bitcoin accumulation. Capital B increased its Bitcoin treasury to 2,925 Bitcoin. This matters because it reinforces the point that strategy is not alone. The treasury strategy is spreading. Some of these companies will execute well, some probably won't, some will overpay, overlever, or mistime things. But even that is somewhat beside the point. The broader signal is that more corporations are deciding that Bitcoin belongs on the balance sheet. And that is still a huge shift in the financial culture. Goldman Sachs filed for its first Bitcoin ETF product. That's one of the biggest symbolic stories of the week. Goldman is not doing this because Bitcoin failed. Goldman is doing this because client demand exists, competitors are moving, and Bitcoin exposure is increasingly too important to ignore. The interesting wrinkle is that this proposed product is designed not just to provide Bitcoin exposure, but also to generate income using options. So once again, Wall Street is taking Bitcoin and feeding it into the yield and structured product machine. That's probably inevitable. And I think Bitcoiners should see both sides of it. On the one hand, this is validation and adoption. On the other hand, it's also more paper layered on top of the base asset. Bitcoin doesn't need the complexity, but Wall Street always does. And of course, we just stay humble, stack sats, and hold it in cold storage. And Wall Street can do whatever they want. Doesn't bother me. Policy, politics, and the state. Virginia enacted a law dealing with unclaimed crypto. This was not the flashiest story of the week, but I think it matters. It shows that Bitcoin and crypto are now normal enough that states are building legal procedures around abandoned accounts, custody, and property handling. Bitcoin is not just a federal talking point anymore, it's now a state level governance issue too. For Bitcoiners, the lesson is simple. Self-custody matters, records matter, inheritance planning matters, and making sure your loved ones know what exists matters. Because if you don't plan ahead, eventually the system will plan for you. Crypto legislation still appears to be moving slowly and unevenly. There were more signs this week that broader crypto legislation is inching forward, but not exactly in a clean or certain way. That feels right to me. The policy climate seems better than it did a year or two ago, but Washington is still Washington. Progress tends to be slow, messy, and full of compromises. For Bitcoiners, the key point is that friendlier policy may help accelerate adoption around the edges, but Bitcoin's real strength is that it doesn't depend on perfect policy to survive. In fact, it doesn't need any policy because it has its own. Good regulation can help, bad regulation can slow things down, but neither changes the core reality that Bitcoin works. A member of Congress disclosed Bitcoin exposure through IBIT. That's another sign of normalization. We are clearly past the phase where Bitcoin exposure by public officials automatically looks fringe. Now it's entering the mainstream political financial world, just like it already has in the investing world. That does not mean Bitcoiners should start cheering every politician who owns an ETF. Ownership is one thing, principles are another. But it does tell you Bitcoin is no longer something serious people in public life feel they must avoid at all costs. Moving along to exchanges and market infrastructure. Kraken reportedly confirmed a confidential IPO filing. This is a major infrastructure story. An IPO means more scrutiny, more access to institutional capital, and more integration into the formal financial system. Whether people like that trend or not, it signals that Bitcoin native companies are maturing into durable institutions. Kraken isn't a fringe startup anymore, it's becoming part of the permanent architecture. Deutsche Börse took a stake in Kraken. That headline says a lot. One of Europe's major exchange operators taking a meaningful position in Kraken is not just a financial investment, it's strategic. It signals that the traditional exchange world increasingly wants direct exposure to crypto native infrastructure. And again, the same theme keeps showing up. The old system is no longer debating whether Bitcoin is real. It is debating how much exposure it wants, what part of the stack it wants to own, and how quickly it wants to move. Kraken owner Payward agreed to acquire Bitnomial. This is another important one because it adds derivatives capability. And if you want to understand how Bitcoin matures as a market, you have to look at custody, ETFs, corporate treasuries, and derivatives. Those are the building blocks of a much larger institutional market. Of course, derivatives also mean more leverage and more complexity. That's the trade-off. Better infrastructure usually brings more scale, but also more gamesmanship. Bitcoin itself remains the fixed point under all of it. Moving right along to security and the technical debate. The quantum debate got louder this week. This may be the most intellectually interesting story in Bitcoin right now. Developers are discussing proposals for how Bitcoin might eventually handle a world where quantum computing becomes a genuine threat to current cryptography. At the same time, critics are warning that some of the proposed remedies could create dangerous precedents, especially if they involve freezing or penalizing coins that do not migrate in time. This is where the conversation gets really fascinating, because the question is not just whether quantum is a threat someday. The deeper question is, what kind of response is compatible with Bitcoin's principles? If Bitcoin starts treating some coins differently than others, that touches a very sensitive nerve. Property rights, immutability, social consensus, and protocol governance all get pulled into the discussion. My view is that it's good this debate is happening now. It's much better to think through this early than to pretend it's not worth discussing. But it's also clear that any proposed solution is going to run straight into some of Bitcoin's deepest values. Moving along to adoption, education, and culture. Tether added more Bitcoin to reserves and kept expanding its wallet efforts. Tether continues to be one of the most fascinating players of the space. It's huge in stablecoins, but it also keeps deepening its relationship with Bitcoin. When a company like Tether adds to Bitcoin reserves and keeps building wallet infrastructure, it reinforces the idea that Bitcoin is still the foundational monetary asset in the broader digital asset landscape. That matters. Even companies built around dollar liquidity seem to understand that the neutral reserve asset in this ecosystem is Bitcoin. The Bitcoin Scholars Fund launched with a $21 million goal. I love this story because it points toward the deeper cultural game. If Bitcoin is going to matter long term, it cannot just be an investable asset. It has to become part of how people understand money, savings, incentives, history, and freedom. That means education matters a lot. Bitcoin is still underrepresented in serious educational settings relative to how important it has become. So any initiative that tries to expand Bitcoin education in a meaningful way is worth paying attention to. Steak and Shake teased a Bitcoin milkshake for Bitcoin 2026. This one is obviously lighter, but I still think it's worth mentioning. Why? Because culture matters. Bitcoin becoming recognizable enough that mainstream brands want to play with it publicly is a signal. It tells you Bitcoin is becoming culturally legible, not just financially relevant. Infrastructure helps Bitcoin grow, but culture is what spreads it. And you can use your Bitcoin to buy food at Steak and Shake. So that was where it all started, but now we have the Bitcoin milkshake. Moving along to the Bitcoin podcast universe themes of the week. This week was unusually aligned. A few themes kept repeating across multiple shows, and it's always worth noting. Theme 1, quantum is no longer a fringe topic. What Bitcoin did, Swan Signal, and TFTC all touch this issue from different angles. That tells me the quantum discussion has moved beyond niche technical circles and into the broader Bitcoin conversation. People are no longer just asking whether it matters, they're asking what a Bitcoin native response would even look like. That's a major shift. Theme 2, inflation, debt, and debasement are back at the center. Shows like What Bitcoin Did spent real time this week on inflation, the dollar system, and the broader monetary endgame. That lines up perfectly with this week's featured Substack post, because that is the real battleground, not just price, but the deeper disease of soft money, debt expansion, and currency debasement. More on that later. Bitcoin matters because it speaks directly to that. Theme 3, the old 4-year cycle narrative is under pressure. Swan Signal explicitly raised the possibility that the old cycle framework may be breaking down, or at least changing. I think that's right. ETFs, treasuries, derivatives, and bigger macro flows have changed the market structure. Cycles may still exist, probably still exist. However, they may not look as clean or as dramatic as the old templates people got used to. Theme 4, conference season is surfacing deeper tensions inside Bitcoin. Conversations tied to BTC Prague and the broader event circuit suggest that this year's conferences are not just marketing events. They're becoming places where people work through real disagreements about custody, regulation, scaling, AI, CBDCs, and the future direction of the movement. That's healthy. A growing movement should have real debates. This week's featured Substack post is Bitcoin versus currency debasement. And honestly, it could not fit better with the week's news, because almost everything we covered today points back to the same truth. Fiat systems respond to pressure by expanding, diluting, refinancing, extending, and distorting. Bitcoin responds by staying fixed. That's the contrast. The war panic, the recovery, the treasury buying, the ETF filings, the inflation podcasts, the legislation, the education stories, it all circles the same core idea. The world is still running on soft money logic. Bitcoin is the hard money alternative. Before we wrap up, did want to mention my 3 Bitcoin Fortress books, links in the show notes on all formats on Amazon. If you want to go deeper into Bitcoin, this is a straightforward and accessible way and a great place to start. Well, folks, that about wraps it up for episode 212 of the Bitcoin Fortress podcast. The lesson this week is simple. Bitcoin keeps getting tested, and it keeps expanding anyway. It gets hit by headlines and recovers. Institutions hesitate, then file products. Companies buy more of it. Developers debate how to protect it. Educators try to spread it, and culture keeps absorbing it. That is what adoption actually looks like. Not one straight line up, but 1,000 different systems, slowly conceding that Bitcoin is here to stay. The longer it stays around, the longer it's probably going to be here. Stay humble, stack sats, and keep building your fortress one block at a time. I will talk to you all next week. Bye-bye.